Good morning. This is Larry McMillan with a stock market update on Monday, July 26th, before the market opens. Last week we had another one of those very short-lived declines. Monday was a pretty nasty day. S&P was down almost 100 points at one time, but then rallied back the rest of the week, and we ended the week at new all-time highs on both NASDAQ 100, the Dow, and S&P. So that's price momentum. That's a very bullish thing. And so the main chart, the main indicator, the chart of the S&P 500 is still bullish. However, beneath the surface, there's still some problems. The first of those is that we have an MVB sell signal in place. That's a McMillan volatility band. And also realized volatility has begun to tick up now. So that's another sell signal after it had been very low during June. These things can be longer term sell signals, though not necessarily immediate reaction. The put call ratios also on sell signals, especially the standard ratio, which just uses volume. That's very bearish. It's still rising. The equity only put call ratio, though, has sort of flattened out, and it's still on a sell signal according to our computer analysis programs, but it's not rising dramatically like the standard ratio is. And the biggest problem internally is breadth. Now, our breadth oscillators did give buy signals after that decline last week, and also what we call the oscillator differential, which is another breadth indicator, gave a buy signal as well. However, they didn't improve much over the course of the week, and as a result, we still have this negative divergence between the market making new all-time highs and yet our cumulative breadth indicators not making new all-time highs. Eventually, that will converge one way or the other. Usually, it's in the convergences that the S&P falls, but not always. As I think we mentioned last week, in 1994, the market continued flat all year while underlying stocks declined. But this current situation is showing up in the Russell 2000 or the IWM ETF. They're both under siege right now, and they're reflecting that most stocks are actually not going up recently. They did a little bit last week, of course, after the major decline on Monday, but the overall market is being led by a handful of large cap and mostly over-the-counter stocks, NASDAQ stocks. Volatility, though, everything is pretty rosy on that front. VIX stays subdued. There was a new VIX spike peak buy signal as of last Tuesday's close, and those have been pretty decent in recent years. Well, actually, for a lot of years, but the last few signals have all responded quite well, and this one already has. So that's positive for stocks, and the construct of volatility derivatives is positive too. That means the term structure slopes upwards all the way up into next year. So we have some mixed signals, but the main thing is that the chart of the S&P 500 is bullish, and therefore a core bullish position should be maintained. You can trade these other signals around it. They will eventually add up to something, but right now the main focus is still the bullish S&P chart and momentum. So I invite you to visit our website. Our daily letters keep up to date on these factors daily. And otherwise, have a great end of July and good luck trading.